Well, welcome to our Chapter 2 recording, Financial Statements. So hopefully you have by now listened to Chapter 1 and you've listened to the intro lecture that I did. You've listened to the WebEx that we did for Week 1. And now we're ready for Week 2 or Chapter 2 also. So let's talk about financial statements. There's 3 financial statements that companies use that we'll focus on: the balance sheet, income statement, and the statement of cash flows. The balance sheet shows, it says financial position. What are your assets, liabilities, and equity? Okay, we'll come back and get to that in further detail. Next is your income statement, which is revenues less expenses, which is your earnings. Do you have net income or net loss for the year? Then finally, your cash flows. What were your sources and uses of cash for your company? Okay, so I'm starting on Chapter 2, page 25 of your book. So the balance sheet is made up of assets, liabilities, and equity. Assets are things that you own that you use to help your business earn revenue: cash, inventories, receivables, buildings. Liabilities are amounts that you owe outside third parties. So accounts payable, a bank loan payable, taxes payable, any bills you have that are payable. Then finally, owner's equity is made up of both retained earnings and paid-in capital. I'm going to go into more detail with about what every one of those means here in the near future. One of those things that you just have to memorize, one of those things that you just have to know when it comes to the accounting is the accounting equation. Okay, and it says right here at the top, assets equals liabilities plus equity. Okay, you absolutely have to know that assets equals liabilities plus equity. Liabilities and equity are your sources of funding. Okay, assets are resources that your business will use to help earn revenue. And then the sources of funding, liabilities are creditors' claims against those resources. Okay, so for example, let's say I'm going to go out and buy a $5,000 piece of equipment for my business. Okay, but let's say I have $2,000 to put down on it. I'm going to borrow $3,000. Okay, so I've got a $5,000 asset with a $3,000 liability, right? The bank's claim to my resource because I borrowed that $3,000 from the bank. And then the owner's claim to the resource, which is the $2,000 that the owner put down. Okay, that's one way to think about it. So equity is kind of maybe like a down payment on something. Now equity here, the owner's claims against resources, it's decreased for dividends and unprofitable operations. So if you have a net loss, for example, and it's increased by profitable operations or by owner investment. Okay, so equity goes up when we have profits or investment from the owner. Equity goes down with losses or by dividends. Here's a sample balance sheet. Now keep in mind, things have to balance in accounting. Okay, here's we have assets that total 340. We have liabilities totaling 200. Therefore, we've got equity of 140. Now my 340 got goofed up. It should be hiding out in the circle right here. But total liabilities and equity is 340, and then total assets is 340. They have to balance. Assets must equal liabilities plus equity. So keep that in mind, that the accounting equation always has to balance. Okay, and they'll walk us through plenty of examples of the balance sheet on pages 26 and 27 of the book. By the way, there's lots of definitions. The bottoms of both pages have some good definitions and summaries of the information that you'll need to know. Same as the top of page 27. There's a good example of what some liabilities are. On the bottom of 27 is an example of equity. The bottom of 26 is examples of assets. Okay, we also can take what we call a classified balance sheet. And when we say we have a classified balance sheet, we're classifying assets and liabilities between current and long term. Okay, current and long term means liquidity. Okay, a current asset or a current liability will basically be used up within 12 months or less. Okay, so a current asset, an example would be accounts receivable, cash, inventory, prepaid assets, which we'll talk about here soon. All those are examples of current assets. They will be used up in 12 months or less. Okay. Long-term assets are typically property, plant, and equipment, a building, land, expensive equipment. They will generally be around for a long time. Same thing with liabilities then. When is the liability due? Is it due within 12 months or less? It's a current liability. If it's due after 12 months, then it's a long-term liability. A comparative balance sheet simply shows 2 years of balance sheet information. Okay, and the reason that's useful is just to show significant changes between 1 year to the next. Okay, limitations on the balance sheet. Most assets on a balance sheet are recorded at their book value, which is historical cost. Historical cost is what we paid to acquire an item minus depreciation. And we'll talk about what depreciation is in the future. Certain assets on the balance sheet are valued at their market value. Investments and inventory would be prime examples of those. We'll talk a little bit about both here as we move forward. Only records or assets and liabilities that can be quantified. We only record assets or liabilities that can be quantified, measured with some kind of a number. And anytime we are recording a number in accounting, we must have some kind of documentation, source document to substantiate the number. We can't just make up a number. Okay. And so reputation, while that could be a really good thing for a company and will definitely add value, we can't quantify reputation. We can't quantify a good CEO. We can't quantify a brand name. Okay, and so we know those are important things, but we don't make a journal entry for items that we cannot quantify. Okay, in your book, I should also point out that the accounting equation information, there's a big exhibit on the top of page 29. Be sure you understand that the accounting equation is assets equals liabilities plus equity. Okay, here is information on the income statement. The income statement is revenues less expenses. Okay, revenues less expenses. This is on page 32 and 33 of your book. Revenues are increases in resources from the sale of goods or services. Okay, so if I have a business like Walmart, and Walmart is selling items, we all know what Walmart sells. Walmart earns revenue whenever we go into Walmart and buy an item. Okay, they have now earned revenue. They've sold inventory and received revenue in exchange. Okay, we subtract from that expenses, costs incurred to generate the revenue. All revenues have expenses. So just think of a Walmart store and think about what kind of expenses would be incurred to have a store. Employees, the inventory, advertising, utilities, taxes, insurance, the list goes on. Okay, so the goal is to have more revenues than expenses and therefore have net income. So more revenue than expense is net income. More expense than revenue would be net loss. Some other items on an income statement would be earnings per share, which is taking the net income number or the net loss number and dividing that by the number of common shares of stock outstanding. Okay, that would be earnings per share. Also, you could have gains or losses, money made by activities outside the normal operations of a business. Okay, so we all know that Walmart exists to basically buy inventory from suppliers, put it on the shelves, and sell it to me and you as consumers. Okay, now Walmart on occasion has to do other kinds of transactions that are just a part of doing business, but is not a part of their core operations of buying inventory and selling it. Maybe they have to buy land because they want to expand. Okay, they decide not to build on that land, so they sell it, and they might sell it for a gain because they bought it maybe 10 years ago thinking they'd build on it. The city didn't move in that direction, so they sold it 10 years later and probably made a gain. that gain is not from operations, but we still need to record that on the income statement. A statement of retained earnings. A statement of retained earnings will show, this is on the bottom of page 35 and a little bit on page 36, changes in retained earnings over time. Okay, so we start out with beginning retained earnings. We add net income. We subtract dividends to get to our final ending retained earnings for the accounting period. So retained earnings is basically the sum of all the earnings, the net incomes that a corporation has had, minus dividends paid out. Okay, so we just show that every year what made retained earnings change. The statement of cash flows organizes cash flows by three categories of cash coming in and cash going out: operating, investing, and financing. Operating is cash that comes in and out based on the day-to-day activities that a business has, what it's in business to do. Investing is buying and selling long-term assets, the cash in and out around buying and selling long-term assets. Financing is cash received or paid as a part of either borrowing or selling stock, one or the other. Financial statement articulation, basically what this means is that the financial statements are connected. Okay, they happen in a certain order for a reason and on purpose. Okay. And this same information that you see right here is on page 40. Okay, and we always do the income statement first. Okay, believe it or not, we're just right here in the middle. We do the income statement first, and we're trying to compute revenues. Then we subtract expenses to get down to net income. Okay, so once I know my net income number, that net income number here in the purple flows down to my statement of retained earnings, where I have a beginning retained earning number minus the net income minus dividends to get down to my ending retained earnings. The ending retained earnings number then goes to my balance sheet. Okay, right here. So the balance sheet then I do next where I've got, and you can see the connection here with the balance sheet, is the statement of cash flows is reconciling the sources and uses of cash. Where did that cash number of 110,000 come from? And so we have our sources of cash and our uses of cash, and our net increase of cash was 30 for the year. We had cash of 80 at the beginning, so my ending cash is 110, and that's right here. So over on the left in the yellow is my beginning balance sheet, basically my balance sheet from a year ago. Okay, and then the next accounting year happens. I do my income statement first, my statement of retained earnings, then my balance sheet. And then finally my cash flow. But I'm looking back at last year's balance sheet for some starting points, some starting point for cash and a starting point for retained earnings. Okay. So the cash flow statement again, let me just touch on that just one more time. It's organized into three categories, and this information right here is on the top of page 38. It's basically, think of it as sources and uses of cash. Okay, cash inflows come from the three categories of operating, investing, and financing. So operating activities is cash that a company receives by selling goods and services. If I'm Walmart, it's cash I receive by selling inventory to my customers. Investing is investing in long-term assets, property, plant, and equipment. It says building and lands right there. Financing then is where am I getting any long-term borrowings? If I am, that's cash in, or if I'm selling investments, if I'm selling stock of my company, that's financing. So I'm either borrowing or selling stock and receiving cash flows in through financing. Okay, then my cash flows out, again organized by the same three categories: operating, investing, and financing. Operating is expenses. This is the expenses I incur in the day-to-day operations of running my business. Investing is cash that goes out to buy property, plant, and equipment. Financing then is repaying debt or paying dividends. Okay, so if I take out a loan, that would be a financing cash inflow, But if I repay a loan, that's a financing cash outflow. If I sell stock, that's financing cash inflow. If I pay a dividend on that stock, that's a financing cash outflow. Okay, next is the notes to the financial statements, and this begins on page 41, also on 42. And just think of the notes as the explanation of what the financial statements mean. Okay, it says a summary of significant accounting policies, so we're basically telling the user, here's everything you need to know about our financial statements. So we start out by showing the financial statements, revenues, income statement, statement of retained earnings, balance sheet, and statement of cash flows. And then we have the notes, and the notes will summarize then our accounting policies, any additional information about information found in the financial statements, basically extra additional information. So for example, if we have investments on the balance sheet, we might have a note that discloses what kind of investments we own, what makes up that specific investment number on the balance sheet. If we are a publicly traded company that we have to file with the SEC, there are additional notes and disclosures that we have to provide to meet the SEC's policies. But the goal of providing notes is providing the users of financials with everything that they need to make a decision about our financial statements. Okay, so think of it this way. The goal of this class is to learn how to do financial accounting, which is learning how to prepare financial statements like our income statement, balance sheet, statement of retained earnings and cash flows, and follow the GAAP accounting rules. Remember, GAAP stood for Generally Accepted Accounting Principles, and then meet those rules when we give these external third parties the information that they need to make a decision about our financial statements. So those external third parties are typically investors and creditors. Okay, so that's really what we're trying to do here. And so we're organizing all this information into the financial statements and the notes, giving it to third parties. They will then make a decision about our company. Do we buy stock of that company, or do we give that company a loan? Next is external audits. Keep in mind that auditors, if we're publicly traded, are required by law to audit our numbers to make sure that the numbers are true. They will verify the financial statement balances are prepared according to GAAP. We've got source documents. We can prove the numbers. We can prove out the balances of all of our financial statement lines. External auditors versus management. Owners and management want the best results possible when it comes to financial statements. Owners want to see favorable numbers because then that increases the odds of getting bonuses for employees, makes stock price goes up, and then allows us a better opportunity to obtain loans from a bank. CPA firms, however, need to make sure that they're upholding their reputation, they're not getting sued, and so CPA firms, their job is to make sure the numbers are accurate and can be relied on.